What I'm doing is I'm setting a point in time in the future. In this case, it's
Mhm.
2026. I'm saying, what
Gotcha.
is Tesla doing in that fiscal year? And then
Gotcha.
I'm discounting that back and throwing a multiple on it.
Yashu thinks that Tesla stock today should already be at $402, and that only includes Tesla's auto business. It does not include Tesla's energy business or Tesla's full self-driving or Tesla startups such as Tesla Bot or Dojo. He only includes Tesla's auto business. So let's see what numbers he used to come up with these assumptions.
Okay, what is factual today in terms of hitting the bottom line? And what are the future possibilities of earnings coming from Tesla? So, just the car business in and of itself, and there's a lot of numbers here, but I'll walk you through what's important. First, we have to start with how many cars we think Tesla is going to deliver and by what year. And this is more or less what they've guided for. I have growth slowing down here a little bit past 2026. And this year, about 1.8 million cars delivered. Anyways, the point is we have to set a date, let's say 2026 in this case, and how many cars Tesla will sell in that year. The model says about 6.2 if Tesla follows their 50% long-term CAGR.
CAGR is simply a compounded annual growth rate.
I've modeled in 5 million cars. And with these assumptions on the left-hand side, with ASP being 47,000, margin being 18%, and that's actually a key point of distinction between the last time that we chatted is Tesla's degradation of margin. Now, if you would have asked me back then, I would have said, well, if anything, Tesla's margins probably will flatline, if not go up, because of cost savings. And though costs did go down this quarter for Tesla, we still haven't seen that hit them just the operating line or the gross profit line just yet. Now, I'm so bullish that Tesla will increase margin from here with software revenues and just considering how high margin those are. But still, I think in terms of due diligence, it's probably fair to lower our margin expectations at least for the next couple of years, and hopefully proven wrong on that.
On the left side, we have Tesla revenue per vehicle, and you can see that recently it has been going down due to price cuts. And then on the right side, we can see Tesla cost per vehicle, and this is also going down, although ideally we would want this to go down quicker than revenue per vehicle, because then we can offset that revenue loss with lower costs. However, we have to remember that Berlin is still ramping, Giga Austin is still ramping. Giga Austin doesn't even produce the Model 3 yet. And Tesla is in a process of shutting down and upgrading its factories this quarter, and we saw a rather short shutdown of Fremont just now, so we can expect these costs to keep coming down more, and with that, margins could potentially improve in the future, especially when the macro environment becomes less challenging.
Margin at 18% and throwing a PE of 40, let's say, on Tesla, and we're looking at a long-term EPS growth of 50%. And remember, this is what Tesla guides for their revenue growth. But that gets us to about $235 billion in revenue for the car business, about 40 some odd billion dollars worth of profit. Now, throwing that PE ratio, that multiple on that gets us to about a 1.7 trillion market cap. Now, there's going to be dilution here. We have to discount this back, but that gets us to roughly about 360. Now, you can play with these numbers if you want. You can bring it down to 15 and see how that affects it. These are all our assumptions that we're working with. And of course, no one knows what's actually going to happen.
He is assuming that Tesla will deliver 5 million vehicles in 2026. If Tesla grows at 50% year over year on average, then Tesla should deliver 6.2 million vehicles in 2026. His average selling price is set at $47,000. The Cybertruck is going to push that up. However, the next generation vehicle is likely going to have a lot of downward pressure on that selling price. He is also using a discount rate of 14%. Some people like to use a lower discount rate, and that would increase Tesla's present value. But most importantly, remember, he's not calculating anything for Tesla's energy or full self-driving or Dojo or Tesla Bot. Nothing. It's zero.
But you'll see the street is only projecting a forward EPS growth rate for the next 3 to 5 years of 25% on Tesla.
Remember that Tesla is generally aiming to increase its deliveries by 50% each year, but Wall Street says that Tesla's earnings will only grow at 25% per year. And likely sometime between now and 2026, Wall Street is going to be a lot more interested in Tesla's energy business as well, giving it perhaps a higher valuation. Because by then, not only will have the Lathrop factory ramped, but also the factory in China that will also make Megapacks will have ramped as well, and possibly we will have many more announcements of factories that will also build Megapacks. And with Tesla's energy business now matching Tesla's auto business margins, you certainly do not want to ignore this huge business.
2026, and you think at that point the market cap should be about $1.8 trillion based on kind of the growth of deliveries and then your price, ASP, and the margin. And that's where you're at with the market cap. Okay.
Yeah, and again, this is just auto. So I think that distinction is important. And also, not to throw a complete wrench into our conversation, but if robotaxis come out by then, I think this whole model is probably broken. And at that point, it's going to be completely nutty.
Based on all of these numbers on a spreadsheet, Yashu thinks that today Tesla stock should already be at $402 just based on the auto business alone. That, for example, does not include any Tesla insurance at all or Tesla energy. Another way to look at it is to take the market cap expectation that he has, $1.88 trillion, and then we take the total number of outstanding Tesla shares. That would be a Tesla stock price target for 2026 just from the auto business, remember that, of $540 per share. But for example, if you assume that Tesla is not going to solve full self-driving, but it just improves it, it makes it much better, and the take rate therefore goes up by a lot, that price target is going to also go up significantly. When I calculated the price target, I used the number of shares on the left instead of the number of shares on the right side here, which makes the numbers a little bit more conservative. Yashu used basically the number much closer to the one on the right here, which makes everything look just a little bit more bullish.
Just with software revenue, let's forget about robotaxis for a hot second. And let's say Tesla continues to sell these cars at a lower profit margin each quarter. Great. But a year from now, they launch a $99 per month subscription package that gets you 100 miles on supercharging networks. It gets you, smart summon. It gets you lane change. It gets you these features that don't cost Tesla anything in terms of variable cost, because when they push out a software update, it's not like it's costing them something to do that, right? You download it over Wi-Fi, your car is the same, there's no parts. Well, now Tesla can make $99 a month, $150 a month, whatever they charge for this ongoing perpetuity, and it's all pretty much margin, right? When Tesla pushes this out eventually, and again, Tesla's probably not going to do this unless they think, okay, robotaxis is still a while away. But if they want to make some additional margin, it's an easy sell to the fleet to have a $99 per month package. And I bet you it would have a huge take rate. So immediately Tesla has this lever that they could pull to increase their EPS should they want it.
I'm not really fully convinced that just lane changes and smart summon and maybe a few supercharger miles would actually get most people to subscribe to this $99 package. But if we threw full self-driving on top of that, yeah, I think many people would actually take that offer. And that is one thing that I absolutely love about Tesla as a Tesla stock investor. There are so many things that Tesla can still do in the worst case scenario that it reduces the risk to me as an investor by a lot in the long term. Personally, I made the decision to go all into Tesla stock, not based on my base case of Tesla stock, but based on my bear case of Tesla stock. In business, things often don't go exactly as planned, although in Elon's case, occasionally things go better than planned. Remember, Tesla was supposed to go bankrupt, is what Elon said many times before, but look at Tesla today. Quite the opposite happened. Tesla is now one of the largest companies in the whole world, but when I project my bear case, I had a lot of bad things happening to Tesla. And Tesla stock still, in 2030, seemingly should be comfortably above where it is trading today. In the recent video where I covered the crucial step required for retiring on Tesla stock, someone asked, how come I was so comfortable holding Tesla stock all the way through December, and it was really pretty easy because I just looked at my bear case and it's a lot higher than where Tesla stock was trading back then, and that's why I was so happy to buy more, and I bought heavily that month. And a lot of people were getting mad at me for saying that it's a Tesla stock buying opportunity when Tesla stock was supposed to go all the way down to $80, $60. Dan Nathan, I think on CNBC, said Tesla stock is going down to $69. Well, I wish that happened because I would have loaded up so much more, but I think what we are going through currently is probably one of these consolidation phases, and we might stay here for quite a while. Maybe for 5 years you might see Tesla stock flat. That's totally possible because for 6.5 years before, Tesla stock basically did nothing. If anything, you could have bought Tesla stock around here, and then years later, 6 years later, 5 years later, you would have actually lost money. So when I buy every month, when I dollar cost average, if I'm buying closer, let's say, to the all-time high, then I understand there's a decent possibility this might happen again, where 6 years later, I might look at some Tesla stock purchases that I made, and these might be at a loss. I am okay with that. I believe it is probably going to experience another huge rise like this one. But you do have to be pretty strong emotionally to hold through all of this volatility, which is why when my family asks me, Matt, how much Tesla stock should I own? I always tell them no more than what you are willing to lose. And that makes it so much easier to hold Tesla stock through these huge dips. I'm not saying that such a small amount of Tesla stock is the right amount for you. You need to work out what the number is for you specifically, but you can't really go wrong with owning no more than what you are willing to lose, because in the case you do, you won't be upset. And if you want to own more Tesla stock than that, then it doesn't matter what I say because you will do it anyway, won't you? YouTube says this is the next video you should watch, but if you haven't finished watching this Elon Musk interview, watch this one first. My name is Matt. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.